What happens when a $400 billion healthcare titan crashes 50% in just weeks, while still raking in billions in free cash flow? UnitedHealth Group just hit a 5-year low, and Wall Street is split. Is this the buying opportunity of the decade or a value trap in disguise? Today, I'm breaking down the full bull case, the bear case, and whether I'm personally buying the dip or walking away. UNH is the largest health insurer in the US, serving over 51 million members. But the real engine? Optum. It's their data-driven, vertically integrated segment, spanning pharmacy benefits, healthcare delivery, and analytics. In Q1 2025, Optum generated 60% of the company's operating income, growing revenues 13% year over year. That's really impressive. UNH is trading at a forward PE of just 15, a level we haven't seen since the 2008 financial crisis. The stock also yields 2.7% and has an average analyst price target of $461, representing nearly 50% upside from today's levels. This is a company with deep competitive advantages. Its scale, Medicare Advantage dominance, and multi-segment integration give it a strong moat. Warren Buffett says to buy businesses with durable competitive advantages, and UNH fits that bill. UNH is a fundamentally strong blue chip on sale. Long-term investors might never see this discount again. However, there are some risks with this stock you can't ignore. UNH is under federal investigation. The Justice Department is looking into potential Medicare fraud, specifically inflated diagnosis codes within its Medicare Advantage business. This segment alone brought in $139 billion in 2024, so if this probe escalates, the impact could be massive, both financially and reputationally. UNH withdrew its 2025 guidance after missing Q1 earnings estimates. EPS came in at $7.20 versus $7.29 expected. Rising utilization rates and medical costs, especially in Medicare Advantage, are tightening margins. That's a tough pill to swallow in a low-growth environment. The stock is down 49% year-to-date, and the RSI sits at just 11, which is extremely oversold. While some traders see that as a buying signal, sentiment is deeply negative. Recent events like the CEO's resignation have only fueled further uncertainty. Legal headwinds, operational issues, and poor sentiment could mean more downside ahead. So, here's my honest take. I'm cautiously bullish on UNH. Let me explain. The fundamentals are still rock solid. In Q1 2025, the company posted $109.6 billion in revenue and doubled its free cash flow year over year. That's not a business in decline. That's a temporary stumble. At a PE of 15, markets are pricing in worst-case outcomes. Historically, this company has traded in the 18 to 22 range. You're getting it at a discount, but with a giant asterisk. But I'm not ignoring the red flags. The DOJ probe is a serious overhang. Similar investigations into other insurers in the past, like Humana in 2018, led to about a 10 to 20% short-term drops, but rebounded once the noise settled. I'd want more clarity before I can confidently say I am a buyer. I'd start a small position under $270, collect the dividend, and treat it as a long-term compounder. But I'd wait for more visibility before going in big. If I already own shares, I'd hold tight and avoid panic selling. UnitedHealth Group, oversold bargain or long-term bust? You tell me. Drop a comment below. Is UNH a buy, hold, or sell in your book? If you found this analysis helpful, smash that like button and hit subscribe for more investing content like this. Looking to start investing? Check out my link to Wealthsimple in the description and get started with your first few bucks.